So how about you give our viewers some insight into what the difference is between good debt and bad debt?
Gladly so. So bad debt is when you wreck debt and you buy, things that that lose value. For example, you get debt to buy a car, or you take debt and go on a holiday that you can't afford. So that is bad debt. That's an example of bad debt. Whereas good debt is actually acquiring debt to buy assets that grow in value, which we call appreciating assets. But there are also other advantages to good debt. For example, besides the fact that the value goes up, receiving an income from those assets. For example, if you're buying a property, then you're actually receiving rent from your tenants. But most importantly, the final one is that the cost of servicing that debt through interest, you can actually claim that cost on tax as a tax deduction. So a good debt should actually have those three elements: appreciating in value, you are receiving an income through, for example, rent, and also the cost of serving that debt is tax deductible. So that's a good debt. That's a true good debt. And it's very, very important for our viewers and our listeners to understand the difference between good debt and bad debt, because good debt will help you to stride along to make sure that you are building assets, whereas bad debt can actually cripple you. It can actually take you way behind financially.
So using the bank's money wisely can actually increase your net worth.
That's exactly right. Because you can actually use rent to pay off the mortgage from your tenants. And then over time, the property grows in value. So you can actually turn debt into building equity over the long term. And that's what we are helping clients to understand between the difference between good debt and bad debt.